Hey folks, Joe Valley here from Quiet Light Brokerage and the Quiet Light Podcast. Thanks once again for joining us. Today's podcast, as always, I know, is sponsored by Quiet Light Advisors, Quiet Light Brokerage, whatever you want to call us these days. We are all serial entrepreneurs that have built, bought, and sold our own online, keyword online business. If you don't know about us, go to quietlight.com. We are here to help first and foremost. Now, before we jump into our pretty amazing guest today, I'm excited to learn along the way with you guys. I'm going to ask a lot of smart, hopefully, questions, probably some dumb ones too. But before we get there, I want to give a shout out to Gino Wickman. Gino is the author of Traction, and his latest book is The Entrepreneurial Leap. So for those of you that are out there in the audience thinking about taking the leap to entrepreneurship, you might want to read this first. It will help you determine whether or not being an entrepreneur is right for you. Now, there are different levels of it, whether you're a visionary entrepreneur or a business owner, where it might make some more sense to buy a franchise and have all the systems and processes in place. But I would suggest that Gino's going to come on the podcast. We're recording in 30 days, so it's probably not going to air until sometime in May. But Gino Wickman, the Entrepreneurial Leap, the author of Traction, co-founder of EOS, and the endorser of my upcoming book, The Extrapreneur's Playbook. But enough about us, enough about me, enough about Gino. Let's talk about today's guest. Her name is Sharon Winsmith. She's from Winsmith Tax, and she lives in New York. She lives in New York, I think, right?
That's
and
right.
The only thing I'm going to say about her introduction is that she did not lie, cheat, or steal, but still paid almost zero taxes in 2020. Is that right, Sharon?
That's right.
All right. We want to know how you did it, but why don't you tell us a little bit more about yourself? I think the intro, the fact that I established it, you live in New York, where it's 13% in New York City. What are the tax brackets in New York?
When you add city and state together, it's over 13%. So
Okay.
You were right.
So the federal and state side is ridiculous. Most people flee New York or California, generally head to Austin, where they're not paying any state taxes. We know a lot of entrepreneurs that have done that, but to go from 13% to almost zero takes some planning, some thinking, and it doesn't happen by accident. So Sharon's going to talk to us about 5 or 6 steps or tips that she can help you employ to minimize your tax, because it's not about how much money you make, it's about how much money you keep. So Sharon, give us a little bit of background on yourself. Did you just jump right into this, or did you go work for a big firm or get a great degree? Tell us about yourself.
Thanks, Joe. So my background is I'm actually a tax attorney, and I spent the past several years working at a Big Four accounting firm. And a few years ago, I kind of identified this area of the market that I feel like is being kind of grossly underserved. And that is entrepreneurs and investors. And so when I say entrepreneurs and investors, I'm really talking about, me and you, Joe, and your audience and owners of businesses or multiple businesses, as well as individuals who have investments in real estate and other passive investments. So I started Winsmith Tax a few years ago to really kind of partner with those types of clients and really help them come up with strategies and ways that they can reduce their taxes.
Okay. Now you said the word tax attorney in there. What's the difference between a tax attorney and a CPA and a tax mitigation specialist and a tax advisor and all these different things?
So that's a good question. So at the end of the day, there's really not that much different. I mean, when you're deciding, for who your tax advisor should be, you should really pick the person who's the right fit and can really proactively bring you, tax tips and suggestions. And so the difference really is a CPA is someone who can, if you're a big company, like a public company, and you need to have an audit done, you need a CPA to do that. I actually cannot do audits of large public companies that need those done. But the only other difference I'll mention is, as a tax attorney, I am an attorney. So while I can help you with your tax return and give you tax advice, I also can comment on the legal implications that are relevant to your business. So I can really kind of come in and advise you from a holistic perspective on what you should really be thinking about from a tax and a legal standpoint. And there's a lot of situations where those two areas cross over. And so being able to really have the knowledge of both can be very helpful.
Thank God people like you are passionate about this stuff because the rest of us are just, I know people's eyes are already glazing over, but this is so, so critical. I have a colleague that he literally pays like 1% in taxes. It's just insane. And I personally have not taken the right steps over the years. I could earn an awful lot less and keep an awful lot more with more plan and implementation things in place. And folks, just for the record, I'm working with Sharon on my own tax mitigation strategies. Back to the tax attorney. You actually go to law school and decide that tax is going to be your specialty. You have to pass the bar and everything as well.
I did, yes. I went to law school, and then I actually did a 4th year that's just specialized in tax law after that. So okay. I did pass the bar. I am licensed in the state of New York as a licensed attorney.
Okay, good. Now we've got that out of the way. Now, some of the things you and I have talked about is that it's good to have a plan in place before people even build or buy a business and start earning real income, because taxes are generally the largest expense that they have. But the reality is, Sharon, is that we're not that thoughtful. We, as entrepreneurs, don't plan things out. It's ready, fire, aim more often than not. Help us with, first and foremost, for those that might be buying a business or, are still, 2 or 3 years in, what are some of the plans that they can put in place for a strategy and structure to mitigate taxes?
Yeah, and you make a good point, Joe, that the sooner in the process you can do this, the better. But what you want, ideally, what would happen is before you buy the business or before you buy any assets or hire any employees or start making money, you come to me and we just, we sit down and go over what are you looking at buying? What are your short-term and long-term business goals and objectives? And then I'd also ask a lot about your personal, life and when do you think you're going to need a lot of cash to buy a house or other situations where you might need access to significant sums of money that might otherwise be tied up in your business. So what we do is we really help you come up with a strategy. And what that means is we'll put you in a structure. So we'll help you decide what legal entities you should have. Should you own the business, through a separate LLC that you set up? Or, how do we want to treat that entity from a tax perspective? Do we want to treat that LLC as, some people may have heard of an S Corp or a C Corp, can sometimes be a strategy that we use. So I'll work with business owners to really help them come up with a structure and figure out, what strategy can we use to really make sure that we're reducing their taxes, but also giving them access to cash when they need it.
It's interesting. I've been self-employed since 1997, so it'll be 24 years in September of this year. And I've always had a CPA, and the CPA is not qualified it's not their specialty. Tax mitigation is not their specialty. They give me some basic advice here and there, maximize your SEP or 401k or Roth when I could do it. I can't anymore, but basic stuff that we can read about. And at one point I met with my attorney and my CPA, and they created this structure for me. And I think I told you, the only ones who made money out of it was them. It got really, really complicated for me. And I didn't really feel or see the true tax reduction. And part of the problem, Sharon, is that people in this audience, and myself included, we are very asset light, right?
Right.
At this point in my life, I don't own any real estate except for the house that I live in. And my business and the people that are listening to this, their businesses, they don't have, machinery and equipment and things that are going to depreciate like crazy to reduce their taxes. How is it that people can maximize their deductions legitimately when they own e-commerce businesses like I do and like the people in the audience do?
Yeah, Joe, and that's a good point. I mean, that is kind of the issue that e-commerce business owners face, is without those large, investments and tangible assets that can depreciate, you really have very little that you can do. So there's a number of things that we can do, and a lot of it depends on, specific facts of every different, business owner, because no kind of two situations are alike.
Yeah,
but,
for sure.
Some of the things that you can consider doing is, kind of the low hanging fruit here is, as a business owner, you really need to kind of always think about things in an after-tax standpoint. And so, anytime, and this is, most people probably know, you need to be maximizing your business deductions, and you need to get creative when thinking about, okay, if I want to go on a trip with my family, how can I tack on a business meeting or some other business purpose that can allow you to then deduct either all or a large piece of that trip. So you really need to be thinking about things in an after-tax standpoint and how can I maximize deductions across the board. And that is the beauty of being a business owner. If you're an employee who's getting a W-2 and a salary from a company, you basically cannot deduct anything. But when you become
So a couple of summers ago, I went to Switzerland. I went to France and Switzerland with my family, and another family came with us. Should I have set up a meeting, even if it's just a lunch meeting or a dinner meeting with somebody in France and Switzerland, to be able to write off a portion of that trip?
And there are special rules that apply when it's international travel, so it does get a little bit
All
tricky
right.
there.
Let's pretend I flew to Wyoming instead.
Well, but even in the international context, so there are ways. It does need to be a bona fide business purpose. So I wouldn't just grab coffee with someone in Switzerland and then write off a large piece of the trip. So you really have to make a bona fide business reason for why a piece of that trip to Switzerland with your family was deductible. So maybe it's you attend a conference for a day, or maybe you try to line up a speaking engagement. I mean, get your name out there, get Quiet Light's name out there. Use it as an opportunity to really market the brand while you're there. So there's all kinds of different ways that you could really do something or carve a few hours out of your trip and make that a business trip.
So a simple thing for me, and I'm going to talk about myself, folks, here, and the things that I could be doing just as examples. So look, we're in a pandemic. I haven't seen my parents. They live in Maine. Haven't seen them for 15 months. And they're getting their second dose of the vaccine in a couple of weeks. At that time, I'd like to hop on a plane or in the car and get up there. What you're saying, though, Sharon, is I need to think about that trip. And why not fly into Boston and go see some aggregators, right? There's 4 or 5 there.
Right.
Have
Absolutely.
meetings with some aggregators, rent a car, and then drive the rest of the way up to Maine. It's a complete business expense, right? Or most of it, except for the drive up to Maine. Yeah.
Right. Most of it would be. And so absolutely, Joe, I mean, yeah, get creative and find ways. Why, exactly like you said, why wouldn't you take that opportunity to tack on an extra, few hours or day to do a bona fide business purpose?
So just some forethought on trips like that. What other types of business deductions could people think about in advance of actually taking trips and plans and things of that nature?
So a big thing that you can do is with your car, because that actually is an asset that could be depreciated. So you can actually take your car and make it a business car, or you can make it largely a car that's used for business purposes. And then that can allow you to take some depreciation for your car, or it can allow you to deduct the fuel expense, when you're going to see a client, that kind of thing. So your car is a great asset where, you can use that as more of a business asset than something you use in your personal life.
So most of us in the e-commerce world really don't need our car to run our business. Now, because of the growth of this, there's more people that we could visit locally, right? If I head to Charlotte, I can go see Bill D'Alessandro and a bunch of other folks that are in the e-commerce space. My CPA has always told me that I need to track my miles that are used specifically for business, and I can only deduct those. Is that what we're limited to, or is there an alternative in terms of, depreciating the entire vehicle?
So what you said is generally right. I mean, you're in a bit of a different situation than I am, Joe. So for example, I am in New York City and I do have a car, and that is a business car because I really only use that car for business purposes. I mean, otherwise you don't need a car in New York City.
Yeah.
So for me, it's a little bit easier, but for you, you're right. I mean, you are using the car largely probably for personal rather than business, unless you can kind of change the way, you think about that. But you are right. You would track the miles, and then, you get a certain deduction for a piece of those miles. But if you're going to a client or something business related and you fill up the car on the way, I mean, that fuel cost is a business expense. It's not a personal.
These are all low-hanging fruit things that I think most people in the audience probably know about. Let's talk about the big things, the things that you're going to advise me to do in the coming years. And some of those are making investments that don't have anything to do with my e-commerce business. It's looking at, I think you call them tax preferred asset classes. Can you, in broad terms, talk about what you'd advise me or somebody in my position to do when I have no write-offs? And these low-hanging fruits, they don't add up to all that much. So what can I do to live like you and pay almost no taxes?
So, and that's exactly right, Joe. So you do need to start thinking about where can I make investments in assets classes that are going to either give me large depreciation deductions or give me kind of tax-free cash flow. And so I think kind of a mistake a lot of people make is they take the money that they get from their business or their salary that they pay themselves from their business and they put it into a stocks
Yes,
into a brokerage account.
Yes,
And
I'm
so,
guilty. I'm guilty. I'm guilty. That's all I do now. Automatically, I send a certain amount of money to Brian up at Morgan Stanley in Portland, Maine, every single month. I'm an idiot. So please
no,
explain all. Look, I'm not an idiot. I'm kidding. But explain all the ways that I am doing things wrong. I think I understand it, but I want to make sure that I have the capacity to do it, right? So there's a payoff, and people are going to need to really understand, is that payoff worth it? So let's talk about what some of those investments would be, and then how we make sure we don't create second or third jobs for ourselves.
yeah, so the absolute best asset class to invest in from a tax perspective is real estate. So we all kind of heard recently that Donald Trump doesn't really pay any tax. And so a lot of people are really surprised by that. But I think anyone in the tax community was kind of like, well, duh, he's a real estate investor. So you really would struggle to make a net profit. You're going to make cash and you're going to get cash every month, but you're not paying tax on that cash because you get these really large depreciation deductions that can offset that income.
So let's actually do two things here, because one thing we didn't do was define depreciation, and you and I understand it, and we're assuming that people listening do. And then a question about interest deduction at certain income levels. So would you define depreciation in this case when it's real estate, please?
So depreciation. So I go out and I buy, let's say, an investment property at the beach that I'm going to use. I'm going to rent that out as, short-term rentals.
Okay.
So when I pay for that property, I get to depreciate the value that is attributable to the building.
Okay.
So you have two pieces. You have the land that the building sits on, and you have the building itself. So you cannot depreciate the land piece. So that's just, you don't get a deduction for that. Right. But I can depreciate the building. And as you can imagine, that is a significant sum of money.
Is that 17 years? How many years is it, the depreciation?
It depends. Okay. It depends. For residential rental, it's 27 and a half. Okay. But there are situations where you can accelerate and pieces of those deductions. I won't get into the nuances of those rules. But so if I go out and buy $1 million rental property, and let's just say for argument's sake, $1 million of that is attributable to the building. Okay. A piece of that would be the land, but I can depreciate that $1 million over the span of 27.5 years. But there are ways to speed that up a bit, and so any rental income I get is going to be pretty much completely offset by that depreciation alone. And then on top of that, you've got other deductions related to the property, like property taxes and that type of thing that you would also claim against that rental income. So
if all I do is break even on that property and get to enjoy it now and then, like I think you are up in Cape Cod right now, instead of being in the city, $1 million piece of real estate deducted over 27 and a half years is about $36,000 a year. If you're just breaking even on that, you're saving, you're reducing your tax load by not 36,000, but you're taking 36,000. Maybe if you're in the 40% tax bracket, it's 40% of that number. So you get the perk of having a property to go to now and then, and you've got other deductions as well. And if you do it right, there's probably going to be some cash flow too. Okay. All right. I got that. All right. We talking about a weekly rental property? We talking about commercial real estate, or is it just whatever tickles your fancy?
It's really anything. I mean, any building that you're going to rent, whether it's commercial or short-term rentals or long-term rentals, you can take large depreciation deductions for that as well.
And those are probably the most passive, right? If it's going to be real estate, because you can put a property management company in to manage it for you and not have to deal with the tenants. Would that be
You
right?
can't. You can. So you need to differentiate when you're talking about real estate investing between passive and active.
Okay.
And so if you are just a pass, and you can also invest in real estate funds. So I have a lot of investment. I don't have the time to really actively manage, real estate because I focus most of my time on my tax business. So I invest in real estate funds. They give me cash. They deposit cash into my bank account every month. And then I get a K-1 at the end of the year from them where I got, this amount of rental money, but here comes my depreciation deduction that's going to completely offset that.
When you're
So
investing in a real estate fund, you actually get the depreciation benefits?
you do. That gets passed on to the owners of the property. So you still get those benefits. And then I will caveat that as a passive investor in real estate, you are subject to a limitation that you typically cannot use those losses because you're going to show from a tax perspective a net loss on that real estate. You cannot usually use that to then offset your other active income if you're a passive real estate investor. But if you have a spouse, for example, that can qualify as an active real estate investor, that is the best case scenario because then the losses are not really generally limited between what you can offset. So if you have a spouse that's got all these losses from real estate investing, and then you've got all this net income from your business, those two can usually offset in that case. And that is the best case scenario.
Okay. Define the difference between passive and active when it comes to real estate investing.
So as a general rule, active real estate, you have to have over 750 hours a year into real estate or managing those properties.
Okay.
There's a few other rules, but so as you can see, there is a high threshold that you do have to kind of pass. You can't just kind of spend a couple hours a week on it and call yourself an active real estate investor. So you would have to kind of go through these hurdles to make sure that you would be considered that. And you can't be like spending most of your time in a business and then also be an active real estate investor. You have to kind of over 50% of your time has to be focused on real estate investing activities.
Okay. So it's not necessarily investing in the real estate funds where you get the income and the depreciation. That can't really be considered active because all you're doing is giving money and you're not spending at least 15 hours a week on it, which is the math there.
That's right. You can't just invest in real estate funds and consider yourself an active investor. You could actively manage real estate properties and meet the definition and then pull in those investments in those real estate funds as well. There is an argument or position that you can take that should all be included.
Okay.
But even if you can't qualify as an active investor, I would much rather get cash flow that's not taxed to me than have this money, 100% of that money in a stock account that I'm going to pay 40% tax on at the end of the day.
Okay. So my brother just opened a storage rental unit facility, where you can store your extra junk. And he's got one building now. And his goal is to have two more in the next 5 years. Would it make sense from my perspective, and I represent the people in the audience, to join forces in a sense with my brother and accelerate the expansion of the storage units and, partially fund or wholly fund the other two, obviously cut an arrangement with him. And there's not a lot of, I got to be honest with you, the buildings there, they're not worth a whole lot. And they're probably, I don't know how they depreciate, but would that make sense in terms of something passive like that as an investment option?
That would, assuming the numbers work out and the numbers make sense, then yes, that would absolutely be a good option. There also are a lot of passive real estate funds that you can invest in that do specialize kind of in the storage unit space as well. But that also qualifies as investments in real estate that you could depreciate. So.
Okay. So I'm going to end up being a passive investor because I'm not going to put the time into it. My wife might be active, but if we're both passive, really just the storage unit thing, or really just investing in is it ETFs that are focused on real estate?
It's really funds. It's just real estate funds. Yeah. And then, the losses that kind of accumulate with respect to those passive investments in the real estate, then we'll just, you get to carry those over, and you'll get to take those in the year that you actually dispose of the property, the underlying property to which those losses relate. So.
Okay. So I'm thrilled and excited to be doing some of these things to reduce my tax burden, as long as it's not going to cost me a lot more time and I'm not going to negative cash flow. I don't have to write a check. I don't want to write a check every month to just reduce my tax burden. That just makes sense, but it doesn't feel right. Mm-hmm. So I get it. I understand. Let's talk about some other alternatives, right? Many of us listening, we're speaking, in my case, live in, relatively small towns, and we all have homes. And, I always see, I've got an air conditioning problem right now, and the folks that will come by, I never feel like they're very good at marketing and services. And I thought, if I wasn't doing what I'm doing now, maybe something like that would make sense. But that's very service oriented, actually. There's not a lot of equipment there, I guess, other than trucks that people drive to go and perform these services. Would something like that make sense if it's fairly passive and we can all be like Shaquille Prasla and put a CEO in place to run the business? Folks listening probably know who Shaquille is. You don't know him yet. But would that make sense, or what do you think?
That could make sense. I mean, the best, if you're going to do that and kind of buy or invest in these companies that you're going to run more semi-absentee, the bigger depreciation deductions that you can get. So that one sounds good because you could depreciate the trucks. But when you think about like these shipping, businesses, those types of things where the truck is a large portion of that, there's some franchises that you can, buy where there's really large investments in, big tangible assets like that, laundromats, things like the car washes, other things like that, where you could be a passive investor, but they're going to kick off, cash flow to you, but there's going to be these large depreciation deductions that can offset that are great investment opportunities.
I like the idea of a laundromat or a car wash. That sounds very cool. What about retirement funds? My CPA is always, having me max out my SEP. I tried to figure out, you and I talked about it, a backdoor Roth. I've got money that's not in a Roth. I'm not qualified to put money towards a Roth anymore. You had said at one point to stop investing or stop using 401ks and IRAs and things, or traditional IRAs and things of that nature. What in that area, that part of our investing, would you recommend people focus on and change?
Yeah, that's an excellent question, Joe. And this is one of my favorite talking points because I absolutely hate.
You're about to geek out on this then, aren't you? Okay, go ahead.
I hate 401ks. I hate traditional IRAs. The first thing I would tell any client is stop. Unless you are in a situation where your company is matching what you're putting in, which is not going to be the case when you're the business owner, then stop contributing to those. All you're doing is deferring the tax burden down the road. And it's terrible. I'll talk to you about why those accounts are terrible. You're right. A traditional IRA is great if you can. There are income limitations on who can make contributions to a Roth IRA.
Yeah.
So if you can do a Roth IRA and you are below those income thresholds, those are great. I'm a big fan of Roth IRAs. You can do backdoor. So if you do have a traditional IRA, there is a way to do a backdoor Roth IRA. So if you are above these income thresholds, you could still do a backdoor Roth IRA in some cases and convert that traditional IRA to the Roth IRA. But you will be subject to tax on the amount in that account at that point.
So you and I are talking about this now, and I just had to make a note to reach out to Brian to ask him about the backdoor Roth IRA. So I will get that done. And the situation there, folks, is that I'm going to go ahead and pay some taxes now if I do a backdoor Roth and I convert money to a Roth IRA from my SEP and 401k. But the upside is that it's going to grow tax-free. And when I take it out, I'm not going to owe any taxes, right? I'm not going to pay anything at all. So I'm willing to pay it now because odds are taxes are just going to go up in the future. Simple as that. I'm going to be in a higher tax bracket and taxes overall will probably go up. All right. So I'm sorry, go ahead.
Well, there's a few other things. I mean, with 401ks, for example, you're very limited in what you can invest in. You have very little control over, what investments you can make and can't make, as well as the absolute worst part about these retirement plans is that when you die, the full amount is subject to inheritance tax. So if you're above the estate tax threshold, your heirs are going to get those accounts and be subject to tax on 100% of the money that's in there. And another thing you mentioned, Joe, is that we don't know, we can't predict what's going to happen when we retire. But if I were a betting person, I would bet very strongly that tax rates will go up, and they will go up a lot over the next few years. We can, debate the reasons why that would happen. But I can't foresee a scenario where I wouldn't rather pay tax on that money, let that money grow tax-free in a Roth IRA, and then not be subject to estate tax on it, not be subject to income tax on it when I take it out. And even if you can't do a Roth IRA, there are other strategies that are very similar that we can work with, some of these high earners to get them in similar situations that basically are very similar to what a Roth IRA can do.
Yeah. So, I don't qualify for a Roth anymore. And my CPA always has me, I take a certain amount of payroll. And at the end of the year, she says, well, take this extra amount so that you can max out your SAP. And I think this year I'm like contributing $55,000 to my SAP. Your advice is don't do that. I can't, if it's new money, I can't do a backdoor Roth, I assume, right? Yes or no? If it's new money.
Well, there's very few situations where you can do a backdoor Roth IRA, but you can't kind of keep doing them every year.
Okay.
So yeah.
So your advice to me, and I haven't seen the full details yet, but I can tell it's going to be just stop doing that and invest in something that is passive, and there's lots of depreciation opportunities. Is that right?
Absolutely. Yes. And there are some other ways where that we'll talk about further, where it basically can get you in a structure where it's going to mimic a lot of the benefits of a Roth IRA.
Okay. And I know I'm simplifying the hell out of this, but I'm simple-minded. What can I tell you? All right. So stop using 401ks and traditional IRAs, and those folks that are earning too much to contribute to a Roth at this point anyway, they've got to consider taking that money that they would be putting into the into the SEP or 401ks and putting it in something that's more passive oriented with lots of deductions. Excuse me, folks. Okay. Any other tips or thoughts on that as you want to geek out a little bit more on 401ks and traditional Roths?
The only other thing I'll mention is there can be, I won't get too far into the details, but there can be life insurance policies that we can set you up with that we'll work with an insurance company to set that up. But they basically can give you a lot of the benefits, as well as really have a good estate tax benefit where you're not getting hit on the estate tax on the full amount. Because life insurance policies, if set up properly, you put them in the name of the beneficiaries and they come out of your estate. So they don't even go through your estate for estate tax purposes. So that's just another example of a tool that we can use.
You and I didn't even talk about that. I've got
we
some on my wife. She's got some on me. We've got an umbrella policy. My guys at Morgan Stanley, I would say probably 16, 17 years ago, pitched me on a $100,000 life insurance policy. One time, $100,000, and it would be worth $10 million when I died, even if I died a year later. And I did the math on it, and I was going to invest all of this money, and I was going to let it sit, and I'm not going to die young, and all this, and it was going to be worth so much more. I kind of wish I did it, point blank.
It's important. It's important to make sure you also work with a tax person, because most of these types of insurance policies don't work to accomplish what we want to accomplish. It's only very specific types. And then, so we can really set that up and you can also borrow from it. So if you do need that money after retirement, just like you would have been taking distributions from your 401k or IRA, you can borrow against this policy and get the same effect, but in a more tax preferred way.
So part of our discussion when you do the full workup is going to be about insurance as well.
Absolutely.
And you're going to make me change everything I'm doing, which is good. That's what I'm looking for. I need to, again, I pay a ridiculous amount of money in taxes, and I just shrug my shoulders and say, okay, well, I'm not Donald Trump. In many, many ways, I'm not him, but I'm not a real estate mogul where I'm, maximizing every possible deduction, and I'm paying a lot in taxes. All right. Okay. Ultimately, we're all going to pass on our businesses to somebody. Either it's going to be a new owner that pays us for it. It's going to be a child or a spouse, or maybe we're just going to let it die on the vine, which is probably the worst option. We always at Quiet Light talk about, make sure you decide to sell your business. I'm sorry. I said that completely backwards, folks. You've heard me say it a million times. Plan to sell, not decide to sell. Plan to sell your business. You don't want to wake up and decide, I hate this. I'm tired. I got to move on. It's too much risk. I have too much inventory. these Chinese folks are killing me, or, my utility patent has expired. You want to plan your exit. And we always talk about it from a preparing your business to sell. But from your perspective, you want to get people into conversations with you long before they're deciding to sell. You want them to plan it out so that you can minimize their taxes as much as possible, right?
Absolutely. And that will impact the structure that we put you in from day one, depending on what types of exits you're thinking about. And there can also be restrictions. So, if you're thinking about IPOing your business at some point, we're going to need to know that, because we're going to have to put you in a certain structure that will allow you to do that.
Let's assume most people in the audience are not doing that. I have a client doing it now, but yeah, let's assume they're not. Most people are probably just on the hamster wheel. They thought the entrepreneurial life was going to be amazing. They're spinning and can't get off. And they're going to jump off when they exit. So they're probably an LLC or an S Corp. Probably 95% of the transactions that I've done over the last decade are those. What kind of quick little thoughts and ideas can you give? And I know that no two businesses are alike, nor no two people in the audience are alike, but what would you throw out there for them to consider?
Yeah, so there's a number of different things, and it will depend on kind of what specific structure you have in place. But, as you mentioned, Joe, it's the vast majority of the time it's an asset sale. You have very few buyers who are willing to do a stock sale. If you do get it, that's great, because there's a lot of flexibility that we have there to plan for that. But you don't want a situation where you're planning for a stock sale and then you can't sell your business because you set your structure up in a way where if you do an asset sale, you're going to get killed on the taxes.
Yeah, right. So, right now I can tell you that, again, probably 99% of the transactions are in fact asset sales, and in the asset purchase agreement, the asset allocation is probably on average only 20%, and goodwill is 80%. Now, that doesn't mean much to most folks, but those listening instead of watching, Sharon is smiling and shaking her head up and down. You're like, yeah, okay. So what do we do for those folks thinking in advance?
Yeah, so there's a number of things that we can do. We could try to structure it in an installment agreement where you kind of stagger, the capital gains tax over a number of years. There can be some risks that are associated with.
Yeah, that sounds risky. Is that just a simple seller note?
So you can do it with the seller note, but there's other ways that it can be done where the seller's not involved, and you reduce that kind of business risk of, I have to then get paid only if the seller, or if the buyer, still runs the business profitably. So there are ways we can structure this where it's kind of a play on the installment rules, but you're not contingent on, whoever comes in and buys the business paying you on that note. It's really done more through a trust.
Right. Structure. And what is that called? We had someone on the podcast to talk about those things. What is that called?
Well, there's a number of different trusts. There's the Deferred Sales Trust, which is very popular for business owners. There's Charitable Remainder Trust that can be used if you kind of want to develop or sell, ultimately give a piece of your estate to a charity. Yeah. There's things like ESOPs, but those are a little bit less flexible, and those only really work in a very specific fact pattern.
Yeah. We don't have at Quiet Lab, we don't have enough people on payroll, because we're a lot of independent contractors, just like everybody in the audience. So I don't think an ESOP is going to be an option for 99%. But the charitable remainder trust, the other types of trusts, where, just for the record, folks, it's not an earnout and it's not a seller note. The money goes into a specific, call it a middleman, if you will, and it's there for you, and you get paid on that every year, and you're mitigating your taxes because you're not paying all your capital gains taxes up front and at once. Is that correct?
That's right. That's
broad sweeping terms. I know it's not correct, but in broad sweeping terms, the general picture.
Yeah, that's the general idea. And then there's other kind of, I call them estate planning mechanisms, but there's other mechanisms that can be used. You can set up family office, structures that might make sense in some fact patterns as well. There can be ways to give over time a piece tax-free to your kids, so that some of the gain goes to them, but then you have the kiddie tax rules to think about. So there's really a lot of nuances.
Let's talk actual numbers like we did at the beginning where it was $1 million. Again, somebody selling their business for $1 million. We generally say, look, ballpark on average, you're going to be looking at somewhere around 25% state and federal, depending upon what state you live in. And it goes up and down depending upon the size of what their net income is, of course. But with these different trusts. Can you take that, a typical average 25% down to 20 or 15 or 10, or what are we talking about in terms of total savings?
So, and you have to examine if it makes sense, because these trusts they're not cheap. I mean, they are complex, and they do cost money to set up. So sometimes if the sell price is on the lower end, it doesn't make a lot of sense.
What's your definition of the low end?
So when you get into a sell price of a couple million, that's when these things, I think, start to make sense from an economical standpoint.
Our average closed transaction last year was 1.7. So we're getting close.
Right. So these are more situations where you would start to think about these things. Okay. And it depends. I mean, there's structures where you can eliminate the capital gains tax completely, but you will have to pay some tax on other aspects or items related to that money that you're deferring. But typically you could stagger it out over a couple of years, and that way you can do it and make the amount that you receive such that you're in a lower income bracket and your tax rate is lower each year, rather than just a big, lump sum hit in one year. But the tax rate is actually going to be a lot higher than 24%, because the federal rate would be 24, and then, whatever state on top of that, as well as, there could be other taxes that would apply as well.
This is with the new administration. We're assuming that this is going to go up. Has it gone up already, or is it? We're talking in February of 2021.
It has not gone up already, but I personally would expect the corporate tax rate to go up and the individual tax rate to go up, if not this year, next year. So,
at what point is it too late to engage you in this situation? By way of example, I've got a client, $5.5 million listing. It's a C Corp. It's a very sellable business, and he's going to get it sold. It's already listed. Too late? Now on to the other one. He's launching something in 2 days for $23 million, and that's an S Corp. Neither one of these folks have engaged with someone like yourself. Is it too late for them, or is it still worth a conversation?
I would say, as long as the sale has not gone through, it's always worth a conversation. And there can be situations where it is too late to set these up. If you're under contract, maybe we can do something. But again, it's always better to come as soon as possible. And honestly, we should be talking about how you're planning to exit before you even start the business, because that's really when you want to structure this. But I know people.
It doesn't. Yeah, I know that. I know. And that's great, but it's just not reality, right?
Right.
People bootstrap these things, and they hustle and they work hard, and they wake up, and all of a sudden they've done $5 million in revenue, and their business is worth, $4 or $5 million. That's not a multiple of earnings, folks. It's a multiple discretionary earnings still. Okay. So all of this, they're not going to call you before they ever start a business. I can promise you that.
Right.
They're going to call you and go, oh, wow. My business I thought was worth $500,000, but projecting out, I think I'm worth 10 million by the end of 2021. What do we do? Those are the conversations that are going to happen, and you can still work with them, right? They haven't signed an agreement. You can still work with them. All right. Good.
Yes, absolutely. Absolutely. We can still work with them.
All right. So in my situation, Sharon, I have an e-commerce bookkeeper. I have two of them, one for Quiet Light, one for my other business. And I have two CPAs, one for Quiet Light and one for my other business. I have a financial advisor at Morgan Stanley. And very shortly, I'll have you. Do I have the right team in place, the right experts, or maybe you don't know because you haven't met these other folks? How important is it to have these people being able to communicate with each other, or having the right team in place in general?
I think that is one of the most critical things to the success of your business, is having the right team in place and having it in place as early as possible. I think what you mentioned, Joe, having a good tax person, having an attorney, having an insurance is very important. And so anytime you do anything big with your business, you have to take into account insurance risk and what that might mean, as well as insurance can then become a part of your kind of wealth building strategy, as we talked about, with some ways to kind of, instead of doing these 401ks.
That's a whole new mindset. That's a whole new mindset. Insurance is a wealth building strategy. I've got to focus on
it.
It is.
Okay. It is. And so, and then a good financial advisor is always important. Yeah. And I think it's important that you make sure you're teaming with right people. I think, people always want to just they'll shop around for the cheapest CPA out there, and they'll pay $1,000 to have their return done. But then I question, is that CPA really bringing you strategies that are going to help you reduce your tax? So
by the way, folks, I told Sharon that my CPA cost $1,000. I think she just threw my CPA under the bus.
No, I actually thought you were paying less than that.
You're right. It's like $850.
No, but that's very common. I have people come to me and they're paying, $800 for a business that's worth, several million. And so I view myself, I'm really a member of your wealth building team. I'm not, I do file your tax return, but that is that's not really the value add service that I provide. It's really in partnering with you and helping you identify these strategies, which are going to, make investments in more tax preferred assets and that type of thing. So that's what I am.
All right. Definitely got to have the team in place. If somebody wanted to engage with you, what's the process? Is it, obviously they can find you, they reach out, and we'll give you their contact information in a minute, but is it, what you and I did, is it fairly common? You and I had a conversation about all of my assets and where things were. We didn't even talk about insurance yet. Talked about my kids, school, retirement funds, all that good stuff. And you're going to take, a couple of weeks in coming together with a plan and then present the plan to me. And then we decide to implement and move forward with it or not, right? Is that how it works?
That's right. Yeah, that's right, Joe. And then I always offer a free, phone call as a free consultation. And so, I'll be able to tell really quickly, is your structure already optimized and there's nothing I can do, or are there things that I can do? And I'll tell you, if I can't save you any money, I'm not going to charge you. And then the biggest tax hit will be when you go to sell your business. And so that's where the value we can really bring will really show itself.
And that, folks, means that you have to plan to sell. Don't decide to sell. I know I got it reversed earlier on, but it's all part of the bigger picture that we're doing here at Quiet Light. It's not just, we're not just here to earn money off of you, right? That's not what we do. The more we help you, the more you're going to earn and the more you're going to save. And that's why Sharon is here on the podcast, because you're going to save more money if you connect with her when you decide to sell your business. And we always say eventual exit, right? We're not here to help you exit today or tomorrow. It's your eventual exit when the time is right for you. If the time is next week, so be it. We're here to help. But ideally, we want to see you build a more valuable asset for yourself. And oddly enough, it helps Sharon earn more money and us earn more money, but you get to keep more money at the end of the day as well. Your business is going to be worth more. It's going to be an easier transaction. It's going to transfer easier. You're going to have a better deal structure. And at the end of the day, you can have more money in the bank and you're going to sleep better, right? You're going to sleep better because there's not all sorts of entanglements for 12 to 36 months after closing when you're hoping and praying that you get paid on the back end. We want to put the best deal structure together up front and save as much money on taxes as possible along the way. Okay, folks, it's Sharon Winsmith from Winsmith Tax. How do they find you, Sharon?
You can go to my website at winsmithtax.com and schedule a free consultation, or you can email me at sharon@winsmithtax.com.
I would highly recommend you do it, folks. I've talked to thousands of you at this point, and hundreds of you should be having this conversation with Sharon right now. The rest of you should be paying attention to all of what she said today and looking at different alternatives until your business is going to be big enough or moving in that direction. Or if you really want to do exactly what she says and you don't own a business yet, but you're planning on buying one or building one, then you would call her. But I don't think you're going to get any of those phone calls because we're entrepreneurs. And we say, we got this. And then we don't. And then we have to hire you to help us unravel and fix and go on the right path. So Sharon, you're awesome. I can't wait to mitigate my taxes and save an awful lot of money on an annual basis, especially if I ever decide to exit. And I'm not going to live forever. So at some point I would exit. There's no question about it. Thanks for sharing your wisdom and experience with the audience at Quiet Light. I will perhaps have you back on and we'll talk about an update of my own personal tax situation to make it more real for the audience.
Great. Thanks so much, Joe. I appreciate you having me on.
Good to have you here.